Good evening, everyone. I am Krishnamurthy, member of faculty from NISM. I'll be anchoring this Stewardship Conclave, NISM-CFA Stewardship Conclave. At the outset, I would like to extend a warm welcome to the dignitaries on the dais, Dr. C.K.G. Nair, Director NISM, Sri Ananta Barua, whole-time member SEBI, Mr. Vidushekhar, Senior Country Head, CFA Institute, Dr. V.R. Narasimhan, Dean NISM, my faculty colleagues from NISM and also from CFA Institute, a warm welcome once again to this wonderful program. Yesterday, we kickstarted the program. We had a lot of deliberations on the contours of stewardship, not only in India but also across the global jurisdictions as well. We had a beautiful panel discussions and we also had a presentation as well. Today, to kickstart it further, to take it to the regulatory level, we have with us whole-time member SEBI and also Dr. C.K.G. Nair, Director NISM. I would like to invite Dr. C.K.G. Nair, Director NISM, to address the participant. Before I hand over the session to sir, a brief introduction about Director NISM. Dr. C.K.G. Nair is currently the Director of NISM. In March 2021, sir demitted the office as a member, Securities Appellate Tribunal, Mumbai. Prior to joining SAT, sir was an officer of the Indian Economic Service, 1985 batch, for about 31 years, and he held various positions in the Government of India. Dr. Nair is a PhD in Economics, Market Regulation from Jawaharlal Nehru University, and he also did Masters in Development in Economics from the University of East Anglia, UK, and Masters and Bachelor's degree in Economics from the Kerala University. He has been a member of various working groups and committees constituted by the Government of India, as well as by the various regulatory forums. So I would like to, with this brief introduction, I would like to invite again Director NISM to share his valuable insights with the participant. Sir, it's over to you.
Thank you, Mr. Krishnamurthy. It's a pleasure to be part of these deliberations. And I missed yesterday's program because I was out of my office, though I wanted to participate. So a very good afternoon to all those who are joining in this program from India, and good morning to all those who are joining from the UK and any other Western jurisdiction, if any. And also, if they are listening, I would like to say thanks for enabling this program to Mr. David Stiles and Paulo Gia, and also for my colleagues, Dr. Narasimhan and Mr. Krishnamurthy, and of course, Mr. Ananda Barua, who has been one of a long-standing friend of mine, and we have been knowing each other for a long time. So is Vidu Sekhar. We have been also knowing for a long time. So a warm welcome and good afternoon, good morning to all of you. Governance standards in several jurisdictions, including in India, had a slow progress in the earlier decades, but picked up over the years substantively and substantially. But still, I would say it has been a gradual process, starting basically at the original stage with increasing the public holding in listed companies. So we used to have a time when a lot of listed companies had only 10% of public holding, which we made it mandatory to have 25% in by 2013-14. And after that, substantial focus have gone into improving the governance standards in multiple ways. And in one of the major ways was in terms of improving the composition and the functioning of the Board of Governors in terms of the composition of independent directors, the at least having a woman independent director. And here I recall that one of the listed companies, when they did not have a woman independent director, had replied saying that we have written to 5 prominent ladies and requested them, but none of them is coming onto our board. But this company was in serious trouble when this was happening, and the 5 names, I won't name the people because of various reasons which is happening in our social media, but I would only say that these 5 women were the global leaders of Fortune 10 or 20 companies to whom the company had written when the company itself was in deep financial trouble. So we had examples of this type in, of course, trying to reduce or dilute the importance of corporate governance. But over the years, substantial progress has happened, and a lot of listed companies are now compliant with most of the reform process stipulated by the regulators. And the program on the stewardship code is one of the latest in this escalating strategy of governance improvement. And in fact, I am ready to admit that on the stewardship front, in terms of codifying as mandatory, in terms of mandatory regulation, we are not very advanced, though the regulations have been brought out by SEBI and IRDA only in the recent past. But both, particularly SEBI, has been insisting on a lot of these conditions as part of the corporate governance enhancement or improvement over the years, and in that itself, substantial progress has been done, and but may not be as we expect. And I am sure as we go ahead, we will be enhancing the standards up to the expectations of the global participants in our markets. But another thing in tune with happened is that though in the earlier decade, some of the institutional investors were not actively participating in increasing the awareness of such standards or participating in its actual implementation, of late they have become active votaries, and in fact they are now compulsorily joining the voting process and insisting that the companies follow the regulations or even beyond in practicing the stewardship code and other governance standards which are implied and implicit in the code. And I would also appreciate the role of the institutional investor services, which are also very prominent, and in the last few years have become very strident in their stand in enhancing the governance standards in the listed companies and coming out with very accurate stance regarding a particular agenda being driven before the governing board or even before the general body of various listed companies. So I'm very happy that very experienced people like Mr. Barua, Dr. Narasimhan are present from our side, and Mr. Stiles and Mr. Gia would be representing the other side of the ocean. And we look forward to listening from you about the latest developments, what is happening in the UK and other jurisdictions which you have been monitoring or observing, I would say. So thank you very much for giving this chance, and I look forward to the deliberations. And once again, thanking you. Over to you, Mr. Krishnamurthy.
Thank you, sir. Thank you very much, sir, for your insights. You spoke about the substantial changes in the corporate governance in India, and also the efforts made by SEBI, especially with regard to the disclosure and transparency in the voting process, the way institutional investors vote and they disclose it to the unit holders. And you also spoke about the role of institutional investors in enhancing corporate governance. Thank you, sir. Thank you so much for your insights. Now I would like to invite Mr. Vidhu Shekhar, Senior Country Head, CFA Institute, to share his insights with the participants. Sir, it's over to you.
Thank you very much, Mr. Krishnamurthy, and thank you for the kind words, Dr. Nair. It's wonderful to be here in partnership with NISM. Welcome back all those who were here with us yesterday. I hope you enjoyed the program, the discussions, the presentation and panel discussion that we had yesterday, and would continue to do so. Today, we are especially fortunate to have SEBI whole-time member, Mr. Barua, and also the representatives from the Financial Reporting Council in UK. As some of you would know, UK has played a leading role and has been the country where formal stewardship framework and processes were put in place 10 years ago. Yesterday, in the presentation that my colleague Shivanand made, we presented the state of stewardship in the region, in the APAC region. CFA Institute had conducted a survey and written a report on how stewardship practices have evolved over the last 10 years within the Asia Pacific region. And those of you who were here, you would have heard that that different countries have followed different paths. In some cases, it was mandatory. In some cases, it was not even a regulator-led initiative. It was a industry-led initiative. So there are many different paths. The important thing to remember is that stewardship is important, but it is also complex, and it involves the participation of a number of different types of stakeholders. And yesterday we had this very interesting discussion where we had a Indian institutional investor. We had the CIO of Kotak Mutual Fund, Harsha Upadhyay. We had someone, Mr. Parvatishan, representing Tata Steel, a large listed company. Mr. Jain Gupta, who runs a proxy advisory firm. And we had a representative of the foreign investors who have been driving a lot of attention to stewardship from BNP Paribas, Paul Millen. So those of you who were here yesterday would have heard the very rich and interesting discussion and got a flavor of how how complicated it is. At the institute, everybody knows us for our educational activities. Everyone knows the CFA program, but less people know about the research, the outreach, and the engagement that we do around the world with regulators, with policymakers, with governments, and the fact that we work at all levels. We work with our members and other participants of the investment community as individuals. We work with firms where we promote best practices, and we understand what is stopping them from serving the customer better. And we also work at the system level, with regulators, etc. And especially in India, NISM, I will repeat this. I had said this yesterday, but we owe a very deep debt of gratitude to NISM, because at a time when the CFA community in India was very small, we had just a few hundred members. We signed in 2009 an MOU with NISM, and based on that, we did a number of things. The most important of which was the annual investment conference, which was hosted from 2011 to 2003 for 3 years by NISM, right? So CFA Institute did not have an office at that time in India. In 2014, when we set up an office in India, we took over and we started running the conference. And NISM also started its own annual conference. So we support NISM at their conferences, and they support us, and we work together as knowledge partners in several areas. But I must say that NISM was the one who helped us with their reach and organization to get started on this road. I also want to thank CFA Society India, and the Institute, which is the global organization, works very closely with the India Society, which is the member society of CFA charter holders in India. Mr. Navneet Monoth of HDFC Mutual Fund is the current chairman of the board of CFA Society. So I would like to thank him, as well as Mr. Raj Kalur, who is the board chairman of the Research and Advocacy Committee. So we work very closely with him on all the projects that we do. CFA Society is very active in responding to all the SEBI discussion papers and we are able to do member surveys, bring in information, do basic research, and so on and so forth. And we hope that this continues. India, I think, is a country where we are very effective in working with the community to promote best practices, improve governance, improve market integrity. We hope to continue doing that, and this is a step. This is a step in that direction. Thank you. Also, maybe I should have done this right at the beginning, to Dr. Narasimhan, who was the one who sort of goaded us to get back into action and not wait for the pandemic to go away. And when we started talking about what we can do together, and we both agreed that stewardship is the best place to start, because SEBI has led the whole stewardship movement by introducing the stewardship code and made it mandatory. But now the industry has to follow, and we need to move from implementing the stewardship code not merely as a as a box ticking exercise, a compliance exercise, which now SEBI has come up with something new. We have to do it, but to really engage across all stakeholders and start making a difference to the end investors. With this, I will close, and thank you very much again. I look forward to today's program. Thank you.
Thank you, Mr. Vidishekhar, for providing at the outset highlights of yesterday's deliberation. How we had a 360-degree perspective of the stewardship code as well, and also your engagement of CFA Institute with the various stakeholders, whether it is regulator or with the institutional investors and listed companies, and especially at the special collaboration between NISM and CFA Institute. Thank you so much. Friends, now we move forward to the keynote address. I would like to invite Sri Ananta Barua sir, whole-time member SEBI. Before I hand over the session to sir, a brief introduction about Barua sir. Sri Ananta Barua was appointed by the central government as a whole-time member of SEBI in 2018. Sir looks after various departments, especially the Market Intermediaries Regulation and Supervision Department, MARSD, the Department of Debt and Hybrid Securities, DDHS, Investment Management Department, which takes care of the institutional investors, especially both mutual funds as well as the alternative investment funds, Market Regulation Department, Investigation Department, Enforcement Department, Legal Affairs, Enquiry Education Department, Board Cell, and Parliamentary Affairs Cell. Prior to taking over as a member of SEBI, sir was the Executive Director of SEBI from May 2010 to July 2018. Sir has joined SEBI at its initial years in 1992, so lots of experience and expertise, nearly 3 decades of experience in the securities market. Sir had played an instrumental role in developing regulatory framework for issue and listing of debt securities, alternative investment funds, municipal bonds, securitization, green bonds, rates, InvITs, insider trading, research analysts, especially the 2 important babies which added to the list of SEBI regulated intermediaries, research analysts and investment advisors. Sir was on deputation to Central Bank of Bahrain as advisor from 2004 to 2006, and he had previously worked with Industrial Finance Corporation of IFSCA and National Fertilizer Limited and DCM Limited. With this a brief introduction, I would like to hand over the session to sir. Sir, it's over to you.
Good evening to all. Dr. Nair, Mr. Narasimhan, and Mr. Krishnamurthy, and Mr. Vidishekhar. I'm glad to be here at the NISM-CFA conference on stewardship code. I see that NISM has managed to conjure a galaxy of speakers on this very important and niche subject. Stakeholders management contributes to corporate governance by helping to handle the multiple and often conflicting stakes held by complex networks of groups that surround any company. Corporate governance is important because it determines how a company operates and how it aligns the interests of all its stakeholders. Good corporate governance leads to ethical business practices, which leads to financial viability. Traditionally, India has seen one type of ownership of business, that is family owned, or more popularly promoter owned businesses. Over the past decade, there has been an influx of another type of business, what we call popularly as professional business, where the business has no identifiable promoters. In fact, SEBI has recognized this and brought the necessary changes to its listing regulations on reclassification of promoters as non-promoters. Recently, certain reforms were made by SEBI in the area of controlling shareholders, also as Indian business ownership assimilates and customizes certain operational practices. A stakeholders democracy is something that SEBI has always strived for, and that is reflective in its regulation making. Quite of some reforms made by SEBI over the years are exemplary of the stakeholders' primacy. One ready example would be the way book building process has been so formulated so as to cushion the retail investors from the pricing and other risks. In the typical book build issue, a huge chunk of shares is to be allotted to qualified institutional investors who are informed investors. The retail investors invest on the cushion and guidance provided by the QIBs as regards volume and price. The other pre-listing reforms, such as mandatory promoter contributions and lock-in, which is proposed to be reduced to 18 months, and mandatory price, and as well as post-issue lock-in for anchor investors, presently 30 days, and which is proposed to be increased to 90 days, go a long way to make an issue investor-friendly for small investors. Moreover, to address information asymmetry, disclosure in the offer documents have been made more detailed. There is also handy 10-page document specified as average prospectus, designed keeping retail investors in mind. While the pre-listing reforms are designed to protect the small investors, the post-listing reforms in the form of disclosures and corporate governance requirements have minority shareholders protections as their thrust. The corporate governance requirements in place for over 2 decades now and held by various international media and institutions as among the best have minority shareholders protections as their primary focus. This can be seen from the fact that SEBI listing regulations also contain principles like equitable treatment of shareholders, role of stakeholders in corporate governance, timely informations, disclosures and transparency, shareholders' rights, as well as the board responsibility, that are modeled on the OECD corporate governance principles, in addition to rules with a specific rider that where there is a conflict between the principles and rules, the principles shall prevail. The enforcement cases in the past 5 years are in the indicator as to how principles have led to protecting minority interest. The other post-listing formalities like quarterly shareholding pattern disclosures, including pledge and also non-disclosure undertakings, details, quarterly consolidated financial results, audited and unaudited, with limited review, with line items like ratios, periodic reporting of material events, annual reports, are designed to make the disclosure informative and immediate to the stakeholders, including the minority investors. SEBI's requirement of board evaluations, which involves the assessment of board in relation to the roles and performance, is also leading to objective evaluations of the performance of directors. A significant part of any strong corporate governance framework is participation of institutional investors in the investee company. Certain important regulatory frameworks that have emerged on these subjects are the UK Stewardship Code principles for responsible institutional investors in Japan, the US SEC rules for registered management investment companies on disclosure of voting, etc. The relationship between the investee companies and the ultimate beneficiaries has changed over the years, and the investment chain has become long and complex, with numerous intermediaries standing between the two. An important link in this chain are the institutional investors. Accordingly, globally, the role of institutional investors is undergoing a transition from traditional roles of raising funds and making investment in accordance with the predefined objective. Now the institutional investors are increasingly being expected by their investors to fulfill the stewardship responsibilities and focus towards the preservation of the investment too by collaborating with the investee companies in meaningful ways, all to provide more and better gains and sustainable growth. Emphasizing the new stewardship role of institutional investors, many countries have come out with different norms of stewardship code to be followed by institutional investors. The lead was taken by UK with its stewardship code in 2012, and various other countries followed similar codes and in some cases restricting to voting disclosures. The updated G20 OECD Principles of Corporate Governance launched at the meeting of G20 finance ministers and central bank governors in Ankara on September 2015 also laid stress upon raising dominance of institutional investors, enumerating various principles applicable to such investors in exercise of their increasing responsibility. In view of the increasing importance of institutional investors in capital markets across the world, they are expected to shoulder greater responsibility towards their clients' beneficiaries by enhancing their monitoring and engagement with their investment company. Such activity are commonly referred to as stewardship responsibilities of the institutional investors and are intended to protect and improve their clients' wealth. Such increased engagement is also seen as an important step towards improved corporate governance of the investee companies and as a result protecting the interests of retail investors in such companies. Several countries such as United Kingdom, Japan, Malaysia have prescribed detailed stewardship code to be followed by institutional investors in their jurisdictions. These codes included certain principles applicable to institutional investors, which require investors to have clear and comprehensive policies on discharge of their stewardship responsibilities, management conflicts of interest in fulfilling stewardship responsibilities, monitoring of investment companies, interventions in investee companies, collaborations with other institutional investors, voting and disclosure of voting activity, periodical reporting on their stewardship activities. In India, SEBI has already taken a step ahead in the area of stewardship with respect to mutual funds in requiring detailed disclosure on voting in investment companies. Our extending such policies to the multiple sets of institutional investors could help in strengthening the overall corporate governance. An agenda initiated by SEBI was placed before FSDC in April 2016 to examine adapting various policies, principles of stewardship to institutional investors in India. SEBI was advised to form a committee comprising representatives from SEBI, IRDA, and PFRDA to evolve suitable comprehensive plan. On the basis of the report of the committee, SEBI came out with a circular on December 24, 2019, specifying principles of stewardship code. This code is applicable to mutual funds and alternative investment funds. This came into effect from 1st July 2020. I also would like to highlight that several stewardship principles were already implemented with respect to institutions by way of provisions and regulations and circulars. Mutual funds have to periodically disclose voting policies, actual votes exercised by them in general meetings, investee companies, along with the rationale for such voting. The regulations also provide for clauses to avoid conflict of interest. Further, the compliance officer is required to make a report on transactions by employees from the point of view of possible conflict of interest and submit it to the trustees with his recommendation, if any. Similarly, the SEBI Alternative Investment Fund regulations also provides for clauses pertaining to conflict of interest, primarily requiring disclosure as well as procedures to identify, monitor, and appropriately mitigate conflicts of interest throughout the scope of business. The AIF investors, by ensuring that an entity in which they invest adopts best principles of corporate governance for investment, ensures that a company is IPO ready, as they ensure that such practices are followed even before listing, leading to easy transition to a listed entity. These reforms of SEBI have also resulted in changed voting pattern, which is very welcome sign. Shareholders need a compelling reason to support a promoter's resolutions, and voting yes is not the default options anymore. According to analysis of voting behavior by a proxy advisory firm. A recent study also reveals that mutual funds are increasingly voting on a company resolutions, and there is a marked decline in their abstentions from 13 to 2% in financial year 21 to 2.4% in financial year 21-22. There is also emergence of proxy advisors who provide insight to investors about how to vote on a range of matters that require shareholder approval at the public corporations in investors' portfolio. They have become critical stop on the roadshow when management and activists contest these matters, such as over electing directors. The past few years have been the emergence of proxy advisors in India. These firms provide the analysis and voting recommendations to the shareholders of publicly traded companies. An important aspect of proxy advisory firm is that the relationship with the institutional investors who seek to make company management more responsive towards the need of shareholders or towards the environmental, social, or governance concerns. The company has to respond to the initial recommendation of the advisor, which is then taken into account by the proxy advisors for its final recommendation that is disclosed in its website. The proxy firms can also play a leading role in giving vent to investor concerns by engaging possibility with the companies. This could help amicably resolve contentious resolutions presented before the shareholders. Their role in India is likely to change over the next decade with increasing number of startups or new generations companies coming to the fore. With the new companies with varied business models as well as complex instruments like shares with the differential voting right on the anvil or the ESG mandate, the role of institutional investors and input of proxy advisors will only act as a valuable guide to investors. I would like to conclude by stating that all reforms of SEBI have been designed with the shareholder primacy in mind, and this will continue to evolve in tune with the market dynamics. I thank NISM for this opportunity to be part of this conference. Thank you all.
Thank you, sir. Thank you, sir, for the keynote address and also sharing your insights on the stakeholder democracy. You spoke about the lot of reforms brought by SEBI, whether it is on the stewardship code or enhancing the lock-in period for anchor investors. And you also spoke about the importance of the stewardship code. Especially it helps to improve the overall corporate governance and also to avoid conflict of interest situations as well. And finally, a very important note, actually, even before listing, if this process is there, then it will help in easy transition from an unlisted entity to a listed entity. Thank you, sir. Thank you so much. All of the participants benefited from your deliberations. We look forward to your session in NISM future as well. Thank you, sir. Thank you so much. Friends, we are moving to the next session by Mr. David Stales and also by his counterpart from UK Financial Reporting Council. So kindly stay with us for the time being. So Mr. David Stales is currently the Director, Corporate Governance and Stewardship at the Financial Reporting Council, United Kingdom. He started his career with FRC in May 2014. David was previously working as a civil servant in BIS and for nearly 30 years, and he had a number of posts. This includes his role as an assistant director in the corporate law and governance directorate with the responsibility for policy on directors' remuneration, shareholders' rights, and on corporate governance. All these are key parameters in the corporate governance circle. I also would like to welcome and introduce Mr. Paulo. Mr. Paulo is currently the Senior Policy Associate in the Stewardship team at the Financial Reporting Council, FRC UK. Paulo was responsible for the project management of the assessment process during the first submission window of its application to the 2020 code. He was also involved in various the processes. Especially, he was responsible for the outreach with the Investment Consultant Sustainability Working Group. Before joining FRC, he was a member of the Global Fiscal Policy Team at PwC UK, working with national governments and other international institutions on tax policy. Mr. Paulo holds a master's in International Public Policy from UCL London. So with this brief introduction, I hand over the session to both the gentlemen. Yeah, sir, it's over to Mr. David and Mr. Paulo.
Okay, well, it's an honor and it's a pleasure to talk to you all today. It's been very interesting to listen this morning about the importance of stewardship in India, and we're just going to give a little background and some current information about what's happening in the UK. We've had a stewardship code since 2010 here. As you've introduced us both, well, I'm David Stars. I'm Director of Corporate Governance and Stewardship at the FRC, and actually my whole team is responsible not only for the stewardship code, but also for the UK Corporate Governance Code, which applies to the premium listed sector. We're also responsible for a set of principles for corporate governance in large private companies, which are called the weights principles. So within the Financial Reporting Council in the UK, we're responsible for the codes and for the influence that those codes have over investors and public companies, listed companies, and large private companies as well. I'm going to give a little bit of history to the code and bring us up to sort of a year ago, I think, and then my colleague Paulo, who's in the stewardship part of the team, is closely involved in the new stewardship code and the whole assessment process that's currently going on, to give you information about how we've done that, because we're actually at the stage now in the UK where we admit applicants to the stewardship code. We have to make a decision on whether the quality of reporting that we're receiving is good enough, and whether the applicants can be listed as significant. Okay, so let's go back to 2009 and post the financial crisis, where the government appointed Sir David Walker to look at the corporate governance of our financial institutions. This was a very important seminal report at the time, and Sir David was attempting to find out what had gone wrong, not necessarily with international markets, international finance markets, although obviously that's an important part, but he was looking at the response of UK financial institutions to what had happened, and in particular on trying to answer some very big questions. So what were the boards of these financial institutions doing? What was their reaction to the situation? What happened? What was their attitude to, or what had been their attitude to risk, and what was their response? He was also trying to look at what regulators have been doing as well, whether they were aware of the risks in the market and what the government and the regulators' response to the situation was. But what's relevant to what we're talking about today was his view about the shareholders. So he was also attempting, well, what were the shareholders doing during the situation? Were they involved with the assets with which they were under their control? Were they engaging with the companies? What was their attitude to stewardship? And I think we have to be frank and say that he found that the role of shareholders needed further development, that they weren't as engaged as they should be with the companies that they were invested in, and that if they had been, the response to the financial crisis would have been better. So one of his recommendations in this area was for a stewardship code. He noted that, of course, the UK premium listed sector was governed by a corporate governance code, which has had success, and that had been in place since 1992. And he felt that a similar code setting out the principles of stewardship and setting out the responsibilities of investors. Obviously, investors have rights under the law, but that implies also that they have responsibility. And he felt that should be put on a firmer footing. Now, in the UK at the time, we had an organisation called the Institutional Shareholders Committee. That was, largely speaking, a group of larger investors who invest on behalf of pension funds and insurance, large mutual investors. And they had a set of principles of responsibility, which they owned themselves and were self-imposed, as it were, which occasionally they would update and their members would adhere to. What Sir David suggested was that these principles of responsibility should actually become a code, and that should be put on a more regulatory footing, and that regulatory footing should mean that the FRC should take ownership of the code and make sure that those who have a list of those who wanted to sign up to it, and make sure that the reporting was sufficient, so that there was public confidence in markets. Now, all of this, of course, is based on the link between good governance, good stewardship, and the long-term performance of companies. Now, there's an immense amount of research about this, which I'm not going to go into in depth now, but it is widely accepted, and often it's quite easy to find a correlation, if not a causation. But there's widespread research about the link between having well-governed companies, which in turn are engaged with by good shareholders, good asset managers who pursue their interests on behalf of their clients and their beneficiaries to achieve long-term sustainable returns and performance. And this doesn't just simply have benefits for the shareholders, of course, it has benefits for the clients and beneficiaries and for the wider economy and society as well. So that's the foundation. That's the foundation for it. If we can go on to the next slide, please. Okay, so if we could just track back 7 principles. Thank you very much. The 7 principles of the code at the time, which I'm not going to go into a great deal of depth, we're looking at how stewardship operated in the UK. So firstly, of course, this is public disclosure. being clear to your clients and beneficiaries for asset managers about what your approach to stewardship is and what that entails, so that your clients and beneficiaries can ultimately make decisions about their approach to stewardship and which asset managers they employ or they entrust their assets to in order to get sustainable long-term returns. And then there are a number of more detailed areas which are important. So, for example, conflicts of interest, which can arise in the chain of ownership between clients and beneficiaries and asset owners, say pension funds, and the relationship between asset managers and companies. Being clear about those conflicts of interest. And then we go through the different stages, if I can put it that way, of stewardship itself. So it's how asset managers monitor the companies in which they're invested on behalf of their clients and beneficiaries. What sort of activity does that entail? And moving along, where certain objectives have been set, that perhaps targets aren't being achieved, and perhaps performance is not where it should be. What activities and what escalation will take place by an asset manager in order to drive better performance in a company? And that also means not just individual asset managers, but collective engagement as well between asset managers in order to achieve long-term gains. Now, sometimes, of course, people think that student engagement is all about voting. Well, voting is very important, of course. It's not the be-all and end-all of everything, but ultimately shareholders have rights, and a significant exercise of those rights comes with voting. So being clear about voting with companies in terms of the importance of issues when it comes to AGMs, and in particular where asset managers disagree with management and vote against management in particular situations at annual general meetings, and being clear about that. Finally, they have reporting to clients, and almost this brings us back to point one: being clear not only what your policies of stewardship are, but actually how you acted. And how you how you monitored, how you engaged, how you voted, and reporting back to your clients and beneficiaries, so that they are easily able to tell what it is that asset managers are doing on their behalf. If we can go to the next slide, please. Okay. The early stages of the Stewardship Code in the UK, we had quite a lot of success. We had 300 signatories sign up, I think, within a year or 18 months. That's very good. It represented a significant proportion of assets under management in the UK, and we were pleased with that. And so, but the problem we had was that some of the reporting was weak. So we had some asset managers who were exceptionally good at reporting, and that was clear from the market, and would produce sustainability reports and stewardship reports, and very clear about that. I have to say, though, that over time, these were not necessarily updated. We had some reports that were simply a page long and really didn't say anything rather than what the stewardship policies were, but didn't give any more information. So of these 300 reports, I would say 10 or 20% of them were helpful, but there was a very long tail of reports which was simply not good enough. So we decided to introduce what we call tiering, and that was applying an assessment process to the stewardship reports and deciding which reports were good, which were average, and which were required significant improvement. And then we published these on our website. So we had tier 1, which I've said there was a very good quality report, reporting beyond our expectations. Tier 2 meets expectations, but improvement needed, and Tier 3 significant improvement needed. And we published this on our website. I mean, I think there was a certain amount of controversy about that. Clearly, if you're an asset manager and we deem your stewardship report to need significant improvement, that's in the public space, you might not be too happy about that, but that just simply reflected the very wide range of quality of reporting that we had. Soon after that, we decided to dispense with Tier 3 because we thought the quality of reporting there was simply not good enough. So anyone remaining in Tier 3 after another year was simply removed from the code. So we had 2 tiers, Tier 1 and Tier 2. And that was a significant exercise and achieved a certain amount of success in driving up the levels of performance. If we can move on to the next slide, please. Thank you. What happened next was that we decided to actually review the stewardship code itself. We'd had the original code. There was a small update in 2012. We'd been through the tiering process, but actually there were significant changes in the market for stewardship over those 10 years. There were significant developments in the way that the stewardship practice took place. We were clear that we needed to not simply look at good intentions and good policy statements about what asset managers intended to do, but we really need to know more about what their activities were and what the outcomes of those activities were, which would benefit their clients and their beneficiaries. So we decided to update the code. This was supported by a review which took place at the time around 2018 by Sir John Kingman. He was asked to look actually at the FRC as an organisation as a whole. One of his recommendations was that the stewardship code needed revision, which we'd already started work on. So these were the particular areas we looked at in order to bring about a new code. There was a very long public consultation about this, and what we were attempting to achieve with the new code is set out briefly in this slide. So, you know, getting more out of stewardship for clients and beneficiaries in the wider society and in the economy, setting higher expectations. Creating the phrase we used at the time was creating a market for stewardship. So promoting the focus on clients and beneficiaries and enabling them to decide who to entrust their assets to and make decisions, and make those decisions on the basis of clearer information that was in the marketplace. Aligning the approach across the investment chain, and that refers to the original code was mainly aimed at asset managers, but the new code is set up to accept applications not just from asset managers, but also from asset owners and service providers as well. So it's drafted in a way which means that it's much clearer and simpler for different personnel, different organizations within the investment chain could sign up. And I've already referred to this creating a market for effective stewardship. So because it's aimed not solely at asset managers, but asset owners and service providers as well. So better information from all of those players in the market to their clients and beneficiaries. And as I've said before, reflecting changing investment landscape and societal expectations. The realization that good governance and good stewardship don't simply, the returns from that don't simply benefit clients and beneficiaries, but clearly they benefit the wider economy and society in terms of employment, in terms of sustainable investment for future generations. Next slide, please. Okay, Paolo, am I doing this slide, or are we moving on to your side? I think this is mine, or is it yours?
I'm happy to do this. Yeah.
Okay. Okay. So this slide summarizes the differences between the old code and the new code, and some of this I've covered already, but I point your attention to the new definition there of stewardship, which we spent a long time over getting everything right. Stewardship is the responsible allocation, management and oversight of capital to create long-term value for clients and beneficiaries, leading to sustainable benefits for the economy, the environment, and society. And that is a little mantra that we have that we repeat a lot, but it brings together not just stewardship, but as I said before, the relationship between good governance in companies and good stewardship, and the wide number of benefits that has. The differences between the codes you can see there. So there's the redefinition, which I've spoken about. There's the extension of the code beyond listed equity assets to other forms of assets. This reflects some of the big changes that took place in the market over the 10 years. So you have assets such as fixed income bonds, infrastructure projects, private equity. More of the clients' assets are being invested in a wider range of asset classes. We wanted that to be reflected in the code. We also wanted to focus on the activities within the asset managers and asset owners as well. So their purpose, making clear their purpose when it comes to investment and how they govern themselves. And that can include things like incentives, in the same way that remuneration in companies is an important focus when it comes to governance. The inclusion of ESG factors and how those are actually integrated into investment decisions, and that reflects the new definition. And then very importantly at the end there, reporting on activities and outcomes. So there's a key change there between not simply setting out what I've said before, your good intentions, your policies when it comes to stewardship, but evidencing those. So what did you actually do to follow up your policies in terms of your engagement with companies, and what was the outcomes? Particularly, what was the outcomes in terms of how did those outcomes benefit your clients and your beneficiaries? So that's a useful slide in terms of setting out the differences between the old code and the new code. And I am at this point handing over to Paolo, who's going to take you through what we did in terms of applying the new code and the application process for the announcement that we made 2 or 3 months ago in terms of those successful applicants to the new code.
Yep. Thank you, David. Thank you to the CFA for inviting us. So here on this slide, you can see the new structure of the Stewardship Code 2020. So as David mentioned, we went from 7 principles to 12 principles for asset owners and asset managers that are broadly divided between purpose and governance, investment approach, engagement, and then exercising rights and responsibilities. And then we have also 6 principles for service providers. These principles are on an apply and explain basis, which means that we expect applicants to the Stewardship Code to be able to apply all the 12 or 6 principles and explain how they are applying these principles, also using the reporting expectations that are underlying those principles that help them guide them in reporting on that and explain what kind of example, what kind of disclosure we're expecting from them. So as David mentioned, we went from reporting to the Stewardship Code that could have been done just once and then it would have stayed, to an annual report, which means that an applicant has to send their report every year. This is because of what David mentioned in terms of activity and outcomes. So as we expect reports to provide activity and outcomes from the previous 12 months, then we want to see how this change over time. So if we receive not only new activities, so more new engagement, new voting and other things, but also we expect to see progress in terms of like at the organizational level across the years. So if we receive a report from 2021, 2022, and 2023, then we would expect to see continuous improvement in terms of the organization across the 12 principles. So not only new activity, but to see how they are going forward and going towards more effective stewardship. Right now we have 2 submission deadlines. One is in April and one is in October. So every applicant has 2 opportunities to apply. If they are unsuccessful, they can apply to the following one. And if they are unsuccessful to their second deadline, then they can apply to the following one again, but then they have to update their reporting period. In terms of our assessment, we have a 3-stage process. So right now we get the report from the applicant. One junior member of my team does the first analysis, goes using a framework that we built. Then this analysis goes to a more senior member of my team that looks at this analysis, sees if they agree with everything that has been done in the first analysis, and then make a first call. Then if we still think that the report is marginal, so we can't make a final decision on whether this is successful or unsuccessful, we have other 2 steps that we can use. One of them is to compare this report to reports of similar size and similar types of organization. So it could be small asset managers that invest all in fixed income or local government pension schemes. So we compare them, we see if we're being consistent in assessing them and see if we're doing a good job and we're making the right calls. And then if we still are in doubt, we can send this report to an independent panel of advisors that can give us some suggestions and give their opinion on whether we're making the right call or not. And then again, we made the final call on it. So this will happen last year, and I'm going to talk about the first signature list in a second. But first, I'd like to talk about the review of early reporting, which is something that we did in 2020. So the first application window for signatures to the stewardship code was in March 2021, but some organizations tried to apply the principles of the code already in 2020 inside their reports. So in their sustainability reports or responsible investment reports, they try to go ahead and try to apply the principle to see if they're doing like a good job or if they could improve in some areas. So we looked at these reports. We didn't make a formal assessment, but we looked at them and we gave them some feedback. But then we took those 21 reports, which were mainly from large asset managers, and we tried to understand what worked well, what was there that could have been improved, and we made this review of early reporting, which is a report that we published in September 2020. And in this report, we went principle by principle, looking at context, activity, and outcome. So we tried to explain what we've seen in those 21 reports, and we tried to explain what we wanted, what would be better disclosure, what we were expecting from the real cohort from 2021. So this report had seemed to be like quite appreciated from applicants, and they thought it was quite useful. So then we finally arrived to 2021 when we have the first list of signatories. Can I have the next slide, please? Yeah. So as I mentioned, the first application window was to March 2021. We received 189 reports. Of this, 125 were successful. Of these, the majority were still asset managers, but we had more than 20 asset owners and 12 service providers. So quite a range of different reports. Also between the asset managers, we had very different types. So we had fixed income, we had just listed equity, infrastructure, derivatives, so different types of organizations. The list was published on the 6th September 2021, and we had there was like quite a positive response to it, apart from the few that didn't make the list. So some of them were not that happy. So we had quite a good response, and we publish all the reports that can be seen on our website. So if anybody wants to see what a successful report against the stewardship code is, they can just go on our website and open them. They're all hosted on our website. Now the second window closed in October, so we received a further 104 reports, which is quite a good number. We're expecting fewer of them, and now we are in the process of assessing them, and we will publish an updated list later in early 2022. In the meanwhile, we have a new report that follows what we did last year with the early reports review. So what we did is that this time we had this big cohort of 189 reports. So we looked into them, and we tried to see what was working and what was not working. Compared to last year, though, it was a bit different, because while last year we analyzed each principle, and also we were like explaining what we saw. This year we tried to focus on the main areas for improvement, and we tried to focus on what is better disclosure, what are very good examples of reporting against the stewardship code. So we addressed 5 main areas. The first one is expectations of reporting, that goes across the report. So it's both about format, but also having a report which is like fair and understandable, and that is based on the needs of clients and beneficiaries. The second one is market-wide systemic risks, which is our principle number 4. So try to explain how organizations have worked with other stakeholders to address risks from a market-wide systemic perspective. So not only from a portfolio perspective, but also from a wider perspective. The third one, as David mentioned, was like one of the differences of the Stewardship Code 2020 from the 2010 and 12 one, is that we are focusing on other asset classes. So in this section, we try to explain how organizations that don't just invest in listed equity can address the principles, can apply the principles of the Stewardship Code and still be quite effective in their disclosure. The fourth one is outcome reporting, because as David mentioned, outcome and activities is quite a good, important part of the new code. So we're trying to explain what are good outcomes, how applicants should explain their effectiveness over the year, and what their engagement or their policy, what was the result, and what is the next steps they're going to take, still in this perspective of continuous improvements over the years. And the last one is just a guide on effective engagement. So we try to explain what is a good case study in terms of engagement, what to explain, and what we expect to see. So this is going to be published next week on Tuesday, and it's going to be sent to all our applicants, but also published on our website. So it's ready to see for everybody that wants to have a look at it. And that's it for me. So thank you very much. That was our presentation.
So can we ask questions?
Of course. Yeah, please do.
All right, thank you so much, David and Paolo. I have a couple of questions. I'm sorry to butt in. One is, over all this time, have you faced any pushback in terms of the amount of burden that you are putting on asset management companies, or even from the companies who are at the receiving end of the stewardship, and discussion on costs versus benefit? And a second corollary, let me just ask you this straight away, is what has been the response from the listed firms themselves? When you look at the sum total of all stewardship activities that you had all these years, can you say that because of the work that you have done, the way the companies behave, it has changed in substantial ways, whether in particular industries or overall?
Okay, so on the first question, which is about the pushback, I have to say, very very limited pushback. If anything, I would have to say quite a positive response. And that I would put down somewhat to possibly 2 or 3 factors. The first is sort of the inevitability of what's happening. I think people, for example, the UK Corporate Governance Code has been around now for nearly 30 years. And there's a general acceptance with that code that although sometimes developments take quite a while, because of the flexible nature and the comply or explain nature of that code, the improvements that have taken place in governance have been quite significant in the UK. And I think it was acknowledged that while there was a focus on the corporate side, there wasn't the same focus in terms of activities on the investment side. In fact, if you look way back at an original version of the one of the many different versions of the code that the UK Corporate Governance Code that we've had over the years, there was a section on engagement, but of course it was called engagement, I think, and it was totally unenforceable because it wasn't. It was in a governance code. It wasn't in a stewardship code. So there was a certain inevitability about what would happen, about what was happening, and the fact that not only did we need to focus on the governance of companies, we needed to focus on the stewards of those companies as well. But we also did perform a very thorough public consultation. We've done a massive amount of outreach on all of this. Certainly in the public's mind, the importance of what's actually done with their money, how their money is invested in terms of the mutual investments, in terms of pensions. There's a growing consciousness, a growing awareness of the environmental and social, as well as the governance factors that impinge upon people's lives. That make that very, very important. So I can honestly say that whilst in certain sort of technical areas about the way that we were going to do this, there was a little bit of pushback. Mostly there was acceptance, and certainly in terms of our major major investment body, the Investor Association in the UK, we had a good deal of support from them. So that was good. Sorry, could you remind me that your second question? That was, I think, sorry, your second question was about whether we've noticed any changes. Yes, particularly in the way that firms, companies govern themselves. I'm going to slightly duck that question in the sense that I think it's a little early to tell. I think there's continual research done on the quality of stewardship, the quality of governance, and what that means in terms of long-term sustainable returns. What we are doing at the minute, we've commissioned some research on how the stewardship code has affected the activities of the asset managers themselves. So that's, I think, what we can call stage 1. That will probably be made public early next year, and that will, we hope, reveal a positive response to the stewardship by the asset managers themselves. Now, as next stage is, how does that feed through to good governance in companies? I think that that is research that we will need to continue to do in the future. Because we have to look at governance and stewardship as, in many ways, both sides of the same coin. So good stewardship leads to good governance, leads to good returns, and see that as a virtuous circle. And certainly we'll be going to be looking at that in the future.
If I can just add a quick thing.
I was going to say, Paolo, if you wanted to add to that, please do.
Yeah, just on the second question, I agree, of course, with everything that David said, but we also had some good interaction with some of the asset managers and asset owners that applied to the stewardship code, and they said that not only the stewardship code is useful for the readers of it, so the beneficiaries or the clients, but it has also been useful for the companies that actually apply to the code, because the code has been used as a framework for them to actually review their own stewardship process. So we've been told multiple times that having such a robust framework that analyzes the different aspects of their stewardship process has been very useful to do their own review and to improve their processes over the past year.
I also think it helps, and Paolo explained some of this, is that for the asset managers and the applicants to the code themselves, we give them detailed feedback on their applications. So whether they're successful or they're not successful, they get detailed feedback on where they've done well and where they need to improve. And I think, you know, where you're having a process like this where you have to make a binary decision about whether one's successful or not, that feedback helps get people engaged and helps them to be more positive about the whole process.
Okay.
Thank you, David.
Any other question? Okay. Thank you, Mr. David and Mr. Follow for your valuable time and also sharing your views on the UK Stewardship Code. You spoke about the 7 principles and also about the 2016 tiering, the purpose of the code, the key changes, and the the 3 important pillars of stewardship code, that is engagement, collaboration, and in case of anything finding difficult, escalation to the highest level. Thank you so much. We look forward to seeing you in the NISM and the CFA programs in the times to come. Thank you so much. Thanks a lot.
Thank you very much.
Thank you very much indeed.
Thank you. Good evening, friends. We are just moving to the next session. We had the London flavor of the stewardship code. Now we'll be having a Mumbai flavor. I would like to talk about the stewardship code in India. I would like to invite Dr. V.R. Narasimhan, Dean, the School for Corporate Governance of NISM, to share his insights. And the school has also made an important study on the practices post implementation of the stewardship code in India. So Dr. Narasimhan will be presenting this to the audience. Sir, it's over to you, sir.
I have a very brief presentation on why this stewardship code, what can stewards do, a reality check of the stewardship code in India, and a brief analysis of voting patterns so far, and what are the sensitive issues in effective stewardship practice is what I'm going to present.
So you are on mute.
This is Dr. Nair, my director, Mr. Anand Barwa, whole-time director, a whole-time member of SEBI, and David Stiles have actually made my job very easy in terms of saying why stewardship code at all and what all it can do to make the governance better, and that has already been said in so many words. So I don't think I have to say so many things about why stewardship code. Nevertheless, to start my presentation, I wanted to say a few words. Governance mishaps can be reduced or prevented when you have my goodness, this is becoming a problem. The governance mishaps can be reduced or prevented through shareholder involvement. And if you look at Indian conditions, the private promoters hold about 44% of ownership. Domestic mutual funds hold about, somebody can hold this for me because it's getting going to mute mode very frequently. Anyway, the ownership, look at ownership structure, 44% is with promoters. Domestic mutual funds hold about 7.2%. Insurance companies hold about 5%, and retail owners hold about 9%. Foreign institutional investors hold 21.5%. Looking at this structure, it's quite possible that from private promoters can actually have their way, good or bad, whatever it is. I'm not saying that always promoters are bad, but they will have their own say, and most of the resolutions proposed by them will go through unless somebody resists it or unless somebody is able to make an effective question there. And that's the context in which we want domestic mutual funds and insurance companies to raise their voice where required or support the promoter when required, whatever. That's what exactly the reason why probably the stewardship code was introduced in this country. They need to play this role. They can be vigilant. They can be if they work together. If institutions work together, can move resolutions in general body meetings because together they hold more than 10%. Under the Companies Act, with 10% voting, they can actually move resolutions, and maybe they can involve into interventions of their own way. They can actually interfere, and when they make their interventions clear to the public, quite possibly valuations will have a huge impact on them. And since huge impact will have on their valuations, promoters will be checked, and that's the reason why probably we have to have a good and powerful stewardship code. And rightfully, SEBI has introduced stewardship code in our country. It's only 1 year, therefore I don't think we are in a position to make a comment on the stewardship code as such in terms of how is it working. But what we did is we very quickly went through the stewardship code policy that all mutual funds have initiated. We have taken a set of about 10 AMCs which cover about 80-90% of the Indian equity, which all has the what you call a small mutual fund, foreign origin mutual fund, Indian origin mutual fund, bank-based mutual fund, and standalone mutual funds. We have taken a variety of mutual funds by a sample for a purpose, and with that we have studied what exactly they are saying in their stewardship policy. Ownership is distributed: private promoters 44%, domestic 7%, insurance companies 5%, retail is 9%, and FII is 21.5%. Since private promoters have got less than 50%, and domestic mutual funds and insurance together have got 12%, they have a very powerful way of either promoting their own resolutions or resisting a wrong proposal coming from private promoters. That's a context in which the stewardship code is very critical in our country. Next slide, please. Okay. Next slide, please. Next slide. So what we have done is, in order to check how it, since only 1 year and you don't have full view of what exactly the mutual funds are doing, we did a quick survey of what is the stewardship code policy that is being adapted by various mutual funds. We have taken a sample of about 10 AMCs, which in themselves have about roughly 80% of the assets under management, and they also have a mix of small foreign origin, Indian origin, bank-based, and standalone mutual funds. And we just examined the policies on against each 6 principles that were already discussed by my predecessors. When we see these, it's about most of them, in fact, all of them have got just 6 pages of policy. That is almost, size is almost universally same. I was a little perplexed. That's the reason why I put this point here. Everybody has got only a 6 pages policy, and most of the policies have followed the sequence, wordings, conditions, etc. given this circular. It appears as if they have done only to fulfill SEBI's requirement. It's more a compliance check than a serious stewardship approach, is what I felt when I look at those policies. Next slide, please. The stewardship circular issued by SEBI has given ample freedom and scope for the mutual funds to set up their own stewardship approach to the whole subject. But that's the reason why we saw, is there any creativity, is there any originality in terms of thinking about stewardship? That's a purpose with which I have studied this policy of these 10 mutual funds. What we see is that we believe that statement of objective will provide an unambiguous direction in execution of what they want to do, but many of them have not even said what the policy objective is, and when it was mentioned, it appeared as if it's in compliance with SEBI circular. I've given some extracts over here the point I'm saying is that objective of stewardship code is not very amply explained in these 10 mutual fund policy documents. Next slide. On the ownership and responsibility of the code, which also has to be articulated in the policy, it's again as required by SEBI. It was approved by board policy, no doubt, but largely there was no mention on whether board or board committee will review the operational policy at all. And depending upon organization, some people said investment committee will be responsible for stewardship, or stewardship team or a committee will be responsible for it. Some people said voting committee will be responsible for the stewardship code implementation. And finally, in one case, they had even thought in terms of appointing a stewardship officer. But the point is, I felt that it is more from the compliance perspective than on the involvement perspective. That's what exactly appeared in the way in which this particular principle was attended to in the policy documents. Next slide, please. Okay. Engagement with investee companies, again, the principle required to be attended to by all stewards in this country. When we see this, we have seen, in fact, SEBI itself has given a kind of a clue or a lead to the policy documentation saying that engagement should be related to investment. That's what the general word is in circular. Then I think almost everybody has said that our engagement will be depending upon the threshold limit, and threshold is not public. Is it going to be 10%, 5%, 15%, 20%? The threshold is not mentioned by these policy documents. It is held back by mutual funds. And then level of engagement is related to extent of investment is what generally they made a statement. Again, what is the level of engagement was not defined, except in one case where they said the level of engagement would be, please, earlier slides, please. That's right, stop there. One agency mentioned that it will be engagement will be topical or a practical, and some other one said that engagement will be meaningful and a possibility of success. That's what they said. And then in some AMCs, they have taken a stand saying that in the case of passively managed funds, we don't even want to engage with the company. I'm surprised at the statement saying that in case of passively managed funds, there's no need to interfere. I'm surprised because even in a passively managed funds, equity will still continue to have some value which needs to be protected. Therefore, it should be engagement should be critical for sustaining the value. Engagement is not for the sake of another compliance check. Next slide, please. And then monitoring the investing company. Again, the statements made by companies are very clear. They said that we will monitor only based on the publicly available information or a sell-side research or research report, and attending to the conference calls held by management. That's what they said. As the purpose of monitoring is concerned, they said to ascertain strategy, performance, risk assessment, etc. Our observations are like this. The list of items to ascertain slightly varied, but more or less everybody said why they want to monitor almost on the same lines. But nobody has mentioned how is this monitoring going to happen. Will there be a tool or will there be an SOP? How? What is the method of monitoring? Nobody has mentioned. And most of them have said that it's a part of investment management's responsibility to monitor. Investment manager does monitor the investments, no doubt, but will it be from stewardship, ownership rights perspective? I'm not too sure. Investment manager looks at investments from a different perspective. That has to be understood in a separate way. That's the reason why I'm raising a question. Should this be a specialist function or a part of investment function? Most of them, I think, some of them have retained the opportunity to engage a third party to help in monitoring. That may be one way of looking at it. Next slide, please. Next slide, please. Okay. On policy and intervention, again, intervention only when investment is beyond a threshold. Threshold is not known. I think of late, one or two AMCs said we would like to have an intervention from ESG perspective as well. It's a fairly welcome step, but it's not a universally mentioned parameter. One AMC mentioned that there will be 3 levels of intervention: high, moderate, and low. They can link to the extent of investment. And In all the cases, they said it will be case-to-case basis, and in some cases on best effort basis. I mean, policy intervention, best effort, of course, is no doubt best effort basis only. But then again, there's not much of clarity in terms of when will they interfere and what kind of extent of intervention is not clearly general sense gathered is that hesitation, there's a hesitation in intervention. They did not forthcome in terms of doing an intervention to retain and sustain the value in the company or in the investment. Next slide, please. And then next slide, please. Collaboration with other institutions. There was not a clear-cut approach in this. Collaboration is subject to permissions of law, etc. Most of them were concerned about acting in concert. That's the reason why they were not forthcoming in terms of acting in collective collaborative approach. Collaboration will be only on case-to-case basis and threshold limit, etc. One important point to be observed is that SEBI itself in the circular has encouraged or say given adequate clue that people could work collaboratively to be able to make a meaningful intervention and control the company, but that it's not been taken in full way by the mutual funds is what my view is. They were, I think most of them were worried about the public, what you call persons acting in concert, but actually they have not applied their mind in terms of saying that if we come together, we'll have more than 10% voting rights, due to which we can even actually move resolutions and make new proposals in the general body meeting. That kind of a view was not expressed by anybody at all in these policy statements. Next slide, please. As far as management conflict is concerned, yes, they have identified the management. They have identified conflicts. Most of them have identified conflicts rightfully. But one area where they have missed badly is that what, let us suppose, in a mutual fund, a debt scheme has invested into debt of a company, and the same scheme in the same company, equity has invested into equity. It's quite possible that the way in which debt works and the way in which equity works could be at conflict with one another. It was not recognized by anyone at all. As a lender, quite possibly the lender will say, now let's move them for insolvency. That will militate against the equity investment. So, or say resolution process could be hastened is what one approach of lender, whereas equity holder would like to sustain value in some form. I don't think it has been very well addressed. Similarly, if an AMC is having a sister company in the same group, and that sister company may have some kind of a relationship with the investee company, which may result or into some kind of a conflict. This was not again visualized by any of the AMC at all. But in our country, most of the AMCs are a part of a conglomerate. I'm sure that there will be issues of conflict which was not visualized by AMC. That's one limitation I have observed in these policy statements. The next statement, next slide, please. And as far as the managing conflict is concerned, I think most of them have followed the circulars, suggestions given in the circular. One AMC said, I'll maintain a conflict register, and then when the conflict is observed, they will say we would like to work in the best interest of shareholders. Again, not different statements. And what they said is that to avoid conflicts or manage conflicts, one approach broadly taken is that investment decisions and voting decisions will be segregated completely so that the conflict will be managed. How far it will be working well, I'm not too sure. Chinese all suggested, not too sure how far it will work. And then rationale for decision in the face of a conflict was one another way in which they tried to handle the conflict. I think it's an area which requires evolving. It is still evolving, and I'm sure that over a period of 1 or 2 years, we'll be able to achieve a balance as far as this particular topic is concerned. Next slide, please. As far as disclosure reporting is concerned, most of the time they said we will disclose on the website or on our own website. They said, some people have said we would like to inform our stewardship policy to unit holders annually. In any case, the SEBI circular requires voting to be disclosed on a quarterly basis, which all the mutual funds are doing. And then we have seen, I think, 1 or 2 mutual funds who said that they would like to have their disclosures certified by compliance officers. And then one AMC has gone forward and said, we would like to present our stewardship policy in an easy to read format. But no one has said whether they will disclose the interventions as and when the intervention event occurs. It is not disclosed anywhere. I think it's an important point that the mutual funds have to disclose interventions if they have initiated any. That's going to make a huge difference to the market and valuations of the equity in which they have invested. But nobody has made a statement on this as per our observations. Next slide, please. Then what we did is, during 2021 is the year in which this stewardship policy went into implementation, and we tracked on the voting pattern of AMCs in 2019-20, 1 year before this implementation of stewardship code, and during the year 2021 we tried and see how exactly it's happened. We find that the voting pattern remained the same. It would mean that stewardship code actually has not created any impact at all in terms of the approach towards voting. For example, 91% they have voted for the promoters' resolutions or management resolutions. Abstentions about 4%, and against was 5%. 4%, 5% is the only marginal difference. In some cases, they have voted against. The 5% is the resolutions against which AMCs have voted in 2021, whereas it was only 4% in 1920, and abstinence was 5% in 1920, but abstinence was 4% in 2021, in spite of the fact that AMCs have been requested not to abstain, and it's also made a statement saying that abstaining would mean that you are actually supporting the management. That was the view taken. In spite of it, we did see some abstinence in 2021 as well. We tried to understand, okay, voting for the promoters is understandable. If they have voted against the promoters, what are the resolutions against in which they went against the promoters' proposals? We went and understood that, analyzed it further. That will come in the next slide. We see that in 2019 and 20, the appointment of KMP, related party transactions, EST related issues, mergers and acquisitions of the major items on which the AMCs have voted against the promoters' resolution, management resolutions. In 2021, next slide. Mergers acquisition got a little better traction in terms of number of 16% was cases where they have voted against it. Again, shareholders' rights got some imagination of the AMCs. ESG was more or less constant. RPTs same level, and appointment of KMP again was slightly subdued because some of this percentage went in towards mergers, acquisitions, and shareholders' rights. And the structure of reasons why they have gone against the promoter resolutions remain the same in terms of intensity and extent. Next slide. So what we feel is that yes, stewardship code can make a difference. There's this case for us to conduct a detailed review or a survey of how stewardship code has been functioning. Yesterday's discussions, group discussions, has given a lot of ideas on the basis on which we could actually conduct a survey. We did hear to the investment manager there. What he said and what was written in the policy are not exactly congruent. That gives us a lot of scope for us to conduct research and understand how the AMCs are actually reacting or using this stewardship code for sustaining the wealth and value of their investments. Having said this, in our understanding, there are some sensitive issues one has to be taking care to make the stewardship code effective. First and foremost is that when collaborative approach is suggested in circular, there's a lot of sensitivity, or say people are little worried about whether it will be considered as persons acting in concert. I would suggest that AMCs by themselves all through or through AMFI may approach SEBI to have some kind of a exemption from application of this particular persons factoring concern. Wherever this stewardship code is being applied is one area they could work on. Engaging with companies can have the insider trading implications. There's a precaution required. Adequate documentation is given. If that is the case, if that is done properly, possibly the UPSI can be handled well. Conflict of interest may arise between schemes, between sister concerns. Matured handling is required. We don't find the policy documents actually addressing this issue in so many words. Monitoring is required, but most of the time they have not mentioned how and what they will monitor and how exact. Are they going to monitor from the investor's perspective or from a owner's perspective? That's not coming out very well. They are slightly different in approach is my personal understanding. Whether investment committee should be given responsibility of stewardship or stewardship should be kept away from investment committee, which has to be very carefully decided and handled. Whether stewardship code application will be subjected to any kind of compliance scrutiny or oversight by board, that's also not very clear. And then this has to be attended to very well in that. And engagement and intervention with investee lead to exit in. This is a very important question to answer. Again, we did not find any answer in this. Let us say while in an investee company, the mutual fund is engaging with them in terms of some interventions and suggestions. Should they exit the company at the same time or not? If somebody considers investment and stewardship are same, the approach will be different. If investment is different from stewardship, probably answer to this question will be different. But in case they are able to attend to these issues also while framing their policy, I'm sure that stewardship code will achieve the purposes for which it has been implemented or say suggested by the regulator. These are a few observations we had. With this, I thank you for this opportunity. Thank you. Back to you, Krishnamurthy.
Thank you, sir. Thank you, Dr. Narasimhan, for the wonderful presentation. Actually, the presentation has. Can you hear me, sir? Yeah.
Yeah, we are able to hear you. Yeah.
Yeah. The presentation has now thrown a lot of questions actually. Whether actually the stewardship code is a principal function or a third-party function. As far as policy intervention is concerned, at what scale, to what extent, whether it should be low, medium, high, who will decide that, whether it should be at the mercy of the institutional investors or there a regulatory intervention is required. Collaboration with other institutional investors, whether they will be considered as a persons acting in concern. And as far as managing conflict is concerned, actually you have a lot of good.
Krishnamurthy, you are mute now.
Whether all these managing, whether to manage conflicts or avoid conflicts, if at all done, whether it is in the best interest of shareholders, and with regard to disclosure and reporting, actually whether the interventions need to be disclosed. So it was an exhaustive presentation and certainly a lot of questions thrown open for the forum to decide. And you also had the solutions about the sensitive issues, which are surrounding these those stewardship code as such. So thank you, sir. Thank you so much. I'm sure that the participants have definitely deliberated from this, but I'm just keeping the forum open for question and answer.
So can you hear me?
Yeah, we can hear you.
Hi, Dr. Narasimhan, really insightful presentation, right? So I think it kind of reminds us why we are having this stewardship conclave, right? So why we are having these discussions, because clearly there is a lot of gap in what people like the regulator is saying and what the industry is doing, right? So I thought a couple of things really stood out. I think the fact that a particular AMC says that we are managing this money passively, therefore we don't need to engage stewardship. That's I think that's kind of shocking, right? So I think like if you're a passive fund, you don't like it, you can't exit, right? That's the whole thing about passive funds. If you can't exit, the only option is to engage with those companies on issues, right? So I was just wondering, in your opinion, does it make sense for the regulator or potentially the industry to come out with a guidance document, right, on what is okay and what is not okay, and like, you know, because stewardship circular talks about these principles and all these policies and so on, but does it need a little bit of a guidance document to accompany that?
I've seen Indian mutual fund industry behaving in a particular way. Whenever circular makes some recommendations and industry players have behaved differently, AMFI has issued guiding principles or good governance principles very quite often, and there are quite a few such what's called occasions. Therefore, AMFI could be maybe issuing some kind of a guideline in terms of how to strengthen the stewardship code policies of AMCs. So that's a better way, because if regulator has to come in, they will come, and the flexibility with which the industry has to act will undergo a change. Whereas the regulator wants ample freedom to be enjoyed by the industry is trying to give it away. So it's better that AMFI gives a guideline rather than the regulator himself.
Got you. So we also listened to FRC before this presentation, and clearly what happened was they came out with the policy, and then in 2010 or something, and in the middle they said that, look, stewardship code is not working well, right? So, and then they came out with the updates and revisions and so on, and like 2020 they said that, look, for like, we want to focus on outcomes, right? So this policy and disclosures and reporting, like whatever is not, it's not working well, so we want to kind of put a high, they did tiering, they kind of focused on outcomes and so on and so forth. So I'm just thinking, like, you know, is there like, you know, I mean, we can wait for industry to mature, and then we can start applying these stricter expectations and so on. Or I'm just wondering, like, what you have done with those 10 mutual funds, like that's similar to what FRC does as part of its yearly review of what these like, you know, asset managers are reporting and where the gaps are and so on. I'm just wondering, like, you know, if it's a good idea for like, you know, someone to take up a formal review of these things, because otherwise, like, you know, you will have these kind of gaps, and it just seems like it'll just take time if you leave the industry, like, you know, things to mature on its own. So
now that we have got voting patterns with us, probably we can work on some kind of a survey. It's a good thought to work on a good survey of what exactly is happening, because if you recall yesterday's discussion, the way in which AMCs are working in reality is slightly different from what they mentioned in their policy document. Right. So we need to identify the gap between practices and policy document, and ask them to say that these two are congruent with one another. That's why we can actually look at some kind of a outcome as such. So there is a scope for work in this. Whether, who, why, when, these are the questions to be answered, but there's a scope, yes.
I mean, I would say that this is just the first year, and it's good. There's the first set of reports to have come out, and the process has just got started. If we engage, you know, now, we will see more consistency, less internal, you know, conflicts or whatever, internal contradictions, and so on and so forth. So I'm actually optimistic. You know, they talked about the fact that they first introduced in 2010 and then they revised in 2012, right? So there was a period, early period, when you try something out, then you start improving that. And I completely agree that the next step, you know, the first step was taken by SEBI, but the next step has to come from the industry, and all of us can help move that conversation along. Yes. So I agree with Shiva said that, like, this is the reason why we needed a conclave like this, and we probably need other types of conversations, roundtable discussions, one-on-one conversations, discussions with AMFI and so on. So I think this is a very useful first step.
I agree.
A roundtable will also help, sir. Actually, as I said before.
I would like to listen to our director on his observation about this proceedings today. Sir, if you can throw some light on this.
Well, I agree with whatever Vidhu and you have stated in terms of moving forward. It's a very decision which gets as a decision at a particular stage is the result of lot of activities behind that. So we are in that process. In fact, corporate governance itself has not reached a situation of satisfaction in many parts of the world, even after several decades of concern. And stewardship code is an advanced form of that.
Yes, sir.
So, and with more tightening of several areas, more than the originally conceived corporate governance in terms of board, independent directors, and audit separate committees, all those things. So this is much more active areas are there. So it will take time. And another thing which I found is that in many of the companies, like in fact, I was surprised to see that even UK is moving ahead into beyond the listed companies space. But many of the listed companies do not have enough human resources to even fulfill the compliance functions in the standard box ticking manner. So it also costs companies, and many of our listed companies are actually, they came to the market to frankly tell you that they needed some additional capital which the promoters could not generate. So they thought it as an easy way of raising some funds. So they never thought that they would have to fulfill a lot of obligations as a matter of governance requirements. And most of these professionals cost quite a lot. If you have to appoint competent professionals, they cost quite a lot. And many companies actually don't have that wherewithal of that, or at least not during their distress time at least. Maybe in some years they can manage, particularly when they issue, the year when they issued the IPO, they may be able to manage all those compliance functions well. But after some days, we have seen many cases where the company secretaries themselves have gone away, or generally the company secretary and the chief compliance officer roll into one, and then they don't have any educated hand dealing with that. So it will take quite a lot of time. So ideally, I would say that you focus with respect to the capable companies. I'm just putting in capability in terms of reasonable financial muscle, and then extend it to the other companies, because in any case they will simply throw their hands up and say, sorry, we will do it later when we are in good weather. So
yeah, thank you, sir. Thank you so much for giving your insights on the entire on the deliberations in the conference. Now, friends, it is the time for vote of thanks. I would like to extend the vote of thanks to Director NISM for giving us the support and guidance for successfully conducting this conclave. And I also take this opportunity to thank Mr. Vidushekhar, Country Head, CFA Institute, Dr. V.R. Narasimhan, Dean NISM, and my colleagues, Mr. Shivana, my colleagues at NISM, the IT team, and the APU, and also my counterparts from CFA Institute, Mr. Shivanath, Mr. Harshad, and all other and the entire academic fraternity, and from the participants, from the markets, from the industry, and also the academicians. Thank you so much. Thank you so much. Thanks a lot for making this first NISM-CFA Stewardship Conclave a grand success. We look forward to seeing you again in the ensuing time. Thank you so much. Thanks a lot. With this, we are coming to the conclusion of the competition. Thank you. Thank you, sir. Thank you so much.
thank you. All the best. We will meet again shortly.
Thank you, sir.